This is for Intermediate Accounting, Chapter 7, on the assignment of accounts receivable. On August 1st, a company needs a loan for $500,000 and goes to a bank. What happens is the bank agrees to the loan and says, but we need to have some collateral. So the company wishing the loan assigns over $850,000 of its accounts receivable. And the bank says, that's fine, that more than covers your loan, and if the people don't pay on your receivables, there's enough money to spare. So the bank's okay with that. But they don't want to be in the business of collecting somebody else's receivables, and they say to the company, you go ahead and keep collecting your accounts receivable. They're not really ours, it's only collateral. So then they discuss the fees. The fee is a finance charge of 3%. Now notice this is 3% of the accounts receivable. It's not 3% of the loan. This is 3% of the collateral itself. The interest on the loan is 8%. That is 8% based on the loan amount. So there's two sets of fees here. Think of the interest, that's your basic interest charge. But because the company's risky and has collateral that the bank might need to act on, they're also issuing a finance charge. And they're in essence dealing with these receivables, and that's why it's the 3% of the accounts receivable. So you've got a couple entries right here. The first is the August 1st entry. Then when you read some more, you find that the company collected $650,000 of its accounts receivable during August and September. So prepare the journal entries for August 1st and September 30th. The August 1st entry is easy. You know that the amount that's there is based on the accounts receivable of $850,000. So 3% of that is the finance charge of $25,500. That's the first thing calculated. The company's borrowing $500,000. So that's your credit. So they're actually going to only receive $474,500 in cash. And this amount's all known ahead of time. They know that they're actually not going to get the $500,000. They're kind of building in this extra assignment fee. So that's your entry to record the receipt of the notes payable and the cash. Then, during the month of August and September, every time cash is received on the accounts receivable, the debits to cash and the credits to accounts receivable. It's not really done in one big entries. It's done on a daily basis as those accounts come in. But on September 30th, when the loan is paid, what happens with the loan is you've got to turn around and pay the $500,000, and you're removing it from your book, so you're going to debit notes payable for $500,000. Then you've got to go ahead and calculate your interest expense. Your interest expense is 2 months at 8% times $500,000, or $6,667. So that comes in. And the company has to pay back the loan plus the interest, so they turn around and credit cash for $506,667.